We've dropped in this morning to talk about how we see the mining space, and we pay a great deal of attention to what's going on in mining. That's the sole area in which we invest. The last time we were here, all we talked about was the clock. We had one slide to show you, and the lion clock is a concept which we use to talk about how the cycle in mining is evolving. Because there's been so much happened since the last time we were here, we've had to bring another slide along. And I thought probably most productive to look at how things have performed over the calendar year. So what we're seeing on the screen is the ASX Gold Index, ASX 200 Resources Index, and I've just showed you how they performed calendar year to the last time we spoke. And if you cast your minds back to April, 2015 was still fairly fresh in our minds, and in mining what that meant was flat performance pretty much for gold equities. And if you're in the rest of the mining market, BHP, Rio and just about anything else, you'd gone a long way south during 2015. So having seen the golds go up, albeit by quite a large percentage amount, it was off of quite a low base, and the rest of the market was fairly flat in miners. Although having said that, it was starting to open up a little bit of a performance gap against the rest of the market. But we moved the mining clock, or the Lion Selection Group resources clock, to 5 o'clock just before we saw you. And what we were saying was we're just before the boom. Now, what we'd seen in early 2016 was the major miners, BHP, Rio, etc., change their dividend policies. And I think along with that, we saw investor sentiment towards miners change from these guys are rampantly reckless to hang on a minute. All of a sudden, miners are making sensible financial decisions again. And that allowed investors to start looking at things like upside in those companies. And I think that pretty clearly marked the bottom in sentiment, and for a variety of other reasons, but we've also seen gold perform in that time. So we've moved the clock on twice since we last saw you, from 5 o'clock in April to late May. We moved the clock to 6 o'clock, which means the boom has started, and by that time in May, we were quite confident on the basis, having seen fairly sustained gold equity performance by then. Reasonable performance, or lifting up off the bottom, you could say, across the rest of the mining market. And remember, we're looking at the bigger stocks here, so there's money starting to flow back in here. But we'd also seen a very pronounced difference in performance between the ASX 200 resources and the ASX 200 industrials. So there was a real performance gap starting to open up there. And to us, that was saying money is flowing back from other parts of the market to miners, and certainly in preference to quite a few other things. We'd also started to see an uptick in equity raising trends in mining. Now, that's not necessarily in the bigger stocks. This was looking at, in gold in particular, we were starting to see juniors be able to raise again, which for probably 2 or 3 years they hadn't been able to. And we'd not only seen an increase in the frequency, but also in the deal size, which was taking place in the equity capital markets for miners. So I think all of those things pointed to a very clear sentiment shift back towards miners. And your question, Adrian, on is this a blip, or is this just or is this a genuine bottom that we've seen? I think this was the point at which we were saying this is not a blip. This is where we had seen the bottom. Now, May was definitely not the bottom. The bottom was past us at that point, but we felt very, very confident in being able to say the next boom was on at this stage. The other thing in May at Lion within our business was we were starting to get very, very busy on launching an IPO. It was a small opportunity, a small high-grade deposit in Western Australia, and we'd held on to it for about 5 years. Now, through 2015, we were getting to the point with this investment where we really wanted to start sharing the burden. And I've got to tell you, through 2015, we could not have sold that company in its entirety for $2 million. We couldn't get anything for it. Come 2016, and investor inquiries on this thing were starting to increase. So by May, we started IPO preparations and abandoned all hope of trying to sell it, and developed the concept of not only staying involved, and we were prepared to stay involved as sellers, but staying involved at a much higher valuation, and also in putting a considerable amount of capital into the business. And we could see the IPO market starting to waver and starting to open. Come August, when we visited diggers and dealers and came away with a sort of temperature taking of the sector, which was really quite robust, where investors were keen on gold, But we're also starting to get very, very warmed up on what's next and looking for other parts of the market which were going to run or were safe places to put your money. It was very clear that investor sentiment was quite robust. By August as well, when we moved the clock to 7 o'clock, which is to say the boom is on and it's now well underway. Not that you often see equity valuations move as fast as we have in this stage of the cycle, but the sentimental indicators were very, very strong to tell us that this was the case. We'd also by August raised the money in this little IPO. So we were able to raise $6 million to float it on a pre-money valuation of about $6.5 million, which was an amazing change from only 8 months earlier in late 2015, where, as I said, you were pushing it uphill to be able to get anything for it. The fascinating thing about that deal, and this is a direct read on the market, is that in raising that money, there was literally one promotional meeting for the management of the company with an investor network, and that provided the bulk of the money which came in there. There was a large sub-underwriting component and then a small placement to get the spread. And I have never experienced an equity raising in something which is so, with such a long lead time as an IPO, that has taken place so quickly. So I think what that tells you is that there is money which is in the space which is looking for a home. And by August, when we raised that money, we were seeing money literally be recycled out of profits in Northern Star, Oceania, etc., into some of the smaller things, Saracen, Duro Minerals, etc., and then trickle down again into the more risky things at that really small end of the market. So that's the anecdote that I provide you. But by August, we were also seeing that equity raising trend had gone on quite substantially from there, and we'd seen some very large raisings. Perseus, I think, $105 million. Metals X announced ad diggers and dealers $115 million raising. Independence raised $250 million, which it didn't, to deleverage itself in late July. So there has been substantial amounts of money raised in this space. Now, if you cast your mind back to 2015 and earlier, the only way to raise money as a miner in any substance was to go out to the market with a project which was developed, which you were buying for a known transaction price from a major, and to say these are the cash flows that will come from it. These are transactions where people are raising money to adjust their balance sheet settings or to expand and do different things. So there is a much greater investor willingness to be putting money into the space. And all of those things, combined with the equity market performance that we've seen for the golds, as well as for the broader market through that period of time. So this last chart brings us to up to date. We've seen the gold equity space in Australia more than double and come back a bit. We've seen the ASX 200 Resources Index go up by more than a quarter. And we're seeing very clear signs of people looking for risk and more diverse exposures to mining beyond just gold now. So I think there's empirical as well as anecdotal evidence for you there that the cycle has moved on. And back to the lion clock, that now sits at 7 o'clock. So we're early in the mining boom. These things typically go on 4 years. This is not a short-term thing. We've seen a very quick evolution of the cycle from the turning point in early 2015 to now, and a very aggressive bounce in the golds as you come through that period of time. But in gold's defence there, and I don't think that is overheated at all, we've seen quite a strong run, particularly in the Australian dollar gold price, as the underlying US price had gone up earlier this year. But golds were also positioned, having fixed their costs before anyone else in the industry did, several years in advance, I might add, to have fabulous margins, probably once in a cycle, maybe once in a dual cycle opportunity for golds, particularly in Australia, which explains their performance, but also the opportunity that they still present. We don't see this as overdone. There's still plenty of opportunities in the market, and as I said, we've got several years for these themes to play out now for us to watch. So where we're looking, we see the best opportunities, particularly in gold and base metals markets, where you don't have to go speculating on what an unusual commodity might do. And we're seeing these particularly in our block hole, which is in the pre-development space. There's been money trickled down, particularly in gold, into that space, but there's been a hell of a lot which has been overlooked there, and we're very excited about that. So it's not often that you see those kinds of opportunities which are priced for acquisition, priced for investment by groups like us, but also have a great deal of data for you to call on to understand what the project might be, and track records of people to assess.